All right, and that's a wrap for section 3, the qualitative aspects of charts. And let's do a quick review of what we learned and what we talked about. So we started with this concept of price and emotions and really attaching emotional narrative behind the price patterns in the market. And the reason why we want to do that is because we get better context and better intuition as to why price is moving like it is. So we're moving away from this magic line theory where we have, a head and shoulders pattern is some sort of mysterious pattern that leads to some type of prediction. We're moving away from that, and instead we're looking at price movements as an emotional narrative. And that better explains the reason why they play out like they do. So it's more intuitive and it's more true to what's actually going on instead of just, hey, if some random pattern shows up in the market, then that's predictive. Then we talked about the two states of price. So we started to develop a mental model for how price moves. And there are two states. We're either bouncing around in equilibrium with no directional bias, or we're moving in a trend. And we want to avoid the consolidations as directional traders and try to focus on points in time where there's a clear directional bias in the market. Then we segued into trend theory, where we went over the many reasons that trends exist in markets, such as slow reaction to fundamental shifts, cyclical expansion / contraction, reflexivity, performance chasing, and herding. We went in depth and talked about all those 5. And then we went into the 4 stages of trends on the chart: the sustain, strengthen, weaken, and dissolve. And then those 2 lectures combined to form our full mental model price schematic. So we can take all price action and bucket into 2 different sections. It's either trending or in consolidation. And we want to avoid the consolidation areas and focus on the trend areas. And then within trends themselves, we see 4 different stages of trends. So we can start to identify and classify each part. So sustain is when it's just breaking out of consolidation pattern. Strengthen is when it's continuing on at an ever-increasing pace. Weakening stage is the pullbacks and the test of faith. And the dissolve stage is when the trend's finally ending and going back into a consolidation. So this is very useful as a mental model to be able to quickly look at a chart and classify what's going on. And then finally, we went over the fractal nature in price. So you can't really tell what time frame price action is unless you have that X and Y axis to define it. Because as you zoom in, whether you're on the weekly, daily, and drilling back down, these patterns show up on every single time frame. So we're going to see consolidations and trends on the 5-minute, on the hourly, on the daily, etc. And what happens is these smaller patterns that occur in the hourly and 5-minute charts, the lower time frames, end up creating the larger patterns on the larger time frames. So what's key is defining the time frame that we want to trade. This is the key takeaway from that lecture, because there could be multiple things going on at different times depending on the time frame. So we can have a monthly chart that's trending, but a daily chart that is in a consolidation. And that's because of this fractal nature, where we can have different types of movement depending on what time frame we're looking at. And then we also talked about how larger time frames, because they have more money behind them, and the people that are trading those types of moves in the market are the biggest funds, they're going to have less pattern redefinition. So we talked about how the small time frames, there can be a lot of noise on it because they're doing their consolidation and trending, but their trends can run into certain large time frame forces, which causes them to fail and go back into consolidation. So we emphasize looking at larger time frames, and we're going to go into more depth about that later on in the course. For section 3 action steps, we're just going to take a look at the charts qualitatively. I want you to dig down, just get a more intuitive feel for how price is moving, especially from that fractal standpoint. So take a few of the macro instruments. I suggest E-mini S&Ps, bonds, oil, but you can really take whatever you want. If you like to watch stocks, you can pick those, or currencies. That's fine too. And I want you to review them each week on all time frames. So after each week, just go through all the charts, 5-minute, daily, hourly, 4-hourly, weekly, monthly, and try to identify, those consolidations and trending states of the market, and look how they differ from each time frame. And so the goal of this exercise is to get a feel for how price moves from the lower time frames into the higher time frames. So after you look at these charts enough, you're going to start to see that the consolidations and the trends and the pattern failures in the lower time frame work into forming the higher time frame patterns. And this is going to give you a really solid understanding of how the tape is constantly moving throughout the market. So that's all for section 3. I hope you guys really enjoyed it, and I'll see you soon in section 4.